Hey everybody, so this is going to be part 2 of my video series, Balance Sheet Basics. Now in this video, we're going to talk about current assets. So what are current assets? These are basically assets that can be used to pay off short-term debt obligations and are very liquid in nature. So let's just talk about the different types of current assets. So you can see cash and cash equivalents, short-term investments, accounts receivables, inventory, other current assets, prepaid expenses, and restricted cash. Now, these aren't all of the current assets. Keep in mind that there are a lot of different types of businesses, and they can have different types of assets. So this is just a sample size of what you will commonly see, more specifically in the tech industry. So, let's just go ahead and take a look at Microsoft and their current assets. So the one thing that I want to talk about is pay attention to the order. Now you're going to see that cash always becomes first in the balance sheet because it is the most liquid. Now notice that they have this other line item called short-term investments. And when they add these two together, they do this little subtotal right here that says total cash, cash equivalents, and short-term investments. The reason why they do that is because these three items are going to be the most liquid and will likely be used if they need to pay off any short-term debt obligations. So these three are the most liquid. Now let's just talk about cash equivalents and short-term investments. So in Microsoft's financial statements, they have this note disclosure. They call it Note 1 Accounting Policies. Now in this note, they tell us how they classify these items. So let me just go ahead and read this for you. It says, we consider all highly liquid interest earning investments with a maturity of 3 months or less at the date of purchase to be cash equivalent. Now so basically here it's saying cash equivalents are basically any kind of investments with maturities of 3 months or less. Now the second part, it says the fair value of these investments approximate their carrying values. In general, investments with original maturities greater than 3 months and remaining maturities of less than 1 year are classified as short-term investments. So short-term investments are anywhere between 3 months and 1 year. Now they do have a caveat to this. It says investments with maturities beyond 1 year may be classified as short-term based on their highly liquid nature and because such marketable securities represent the investment of cash that is available for current operations. So the caveat here is, hey, you know what? We can have a short-term investment that is over a year if it's very, very liquid. All right. Now let's go ahead and let's talk about cash equivalents and short-term investments that Microsoft has. So, notice right here that they have cash and cash equivalents and short-term investments. So each of these line items are broken out. So this is basically saying, hey, everything that's below 3-month maturities, hey, everything that's between 3 and 1 year maturities. So you got commercial papers, you got certificates of deposits, United States government securities, U.S. agency securities, foreign government bonds, mortgage and asset-backed securities, corporate notes and bonds, municipalities. And right here, they talk about the different level of equity investments that they have. So notice that they have these different fair value levels. So they got level 2, level 1, and level 3. So level 1 assets are assets with transparent pricing and are very, very liquid. So notice where the level 1 securities are. It's around the United States government securities. Now, if you're talking about US government securities, they're usually talking about treasuries. And treasuries are very safe investments with very transparent pricing. They're basically trading all the time when the market is open. So these are level 1 assets. Now, also pay attention that equity investments, they're also level 1. So these are basically stocks. So stocks, they're constantly trading And you can see the price real time. So it's very, very transparent. It's very liquid. If I had some stocks in Microsoft, I could literally get rid of it as soon as the market opens. So very, very liquid. Now, level 2 and level 3 assets are a little bit harder to value and are less liquid. So, there's just not as much trading activity around it. So, sometimes the value might subtly different. Right here you can see level 3 investments will include municipalities, corporate bonds and notes, and foreign government bonds. So not as much demand for them. They're not as liquid as your United States government securities or your equity investments. Now, accounts receivables, what exactly are they? So an account receivables are basically payments on credit that we will receive in the near future. So just imagine you buy something with a credit card, okay? Let's say I bought a TV that cost $100. Now I got the TV today, but when is that company going to receive the money for that TV that I bought? Well, they're going to receive it at a later time. Basically, when I pay my credit card payment processors, when I pay them with the monthly statement, they're going to disperse all of that money to all of these different companies, and that is when they get their money. So that is accounts receivables. Now pay attention to Microsoft's balance sheet right here. It says accounts receivable, net of allowance for doubtful accounts of 438 and 633. Keep in mind that these numbers are in millions. So this 438 is referring to the September 30th, 2022 period. And this 633 is referring to June 30th of 2022. So sometimes they do mix in numbers like this. You just need to know that this is referring to that and this is referring to that. So it's always basically just organized in that manner where the first is always going to be the most recent. Now, what is allowance for doubtful accounts? Well, allowance for doubtful accounts is essentially just saying, hey, you know what? Out of all of these credit payments that we received, there might be a percentage or 2% or whatever, there might be a small percentage that won't pay this bill. So that is what allowance for doubtful account is. We are assuming that maybe like 1 or 2% or something is not going to pay this bill. So they go ahead and they net that amount. So they get the accounts receivable and they subtract the allowance for doubtful accounts, and then that's how they get these total amounts. So this is net receivables. So it's accounts receivables minus allowance for doubtful accounts. Now let's talk about inventory. So inventory is very, very, very important. So pay attention to how much inventory a company has in relation to their current assets. So if we're looking right here, Microsoft, they have about $4 billion in inventory, but their total current assets is about 160 billion. So it's not a whole lot of inventory that they're carrying. And let me just describe a scenario where having a lot of inventory might be a bad thing. So imagine that you are a clothing retailer, okay? Let's say you have a ton of inventory for the summer, but then now we're going into winter. So if we're going from summer to fall to winter, you're going to want to get rid of that summer clothing very, very fast. But if you have a ton of inventory and all of a sudden, let's say we enter a recession, people, they're going to be very very conservative with their cash. They're not just going to spend it willy-nilly. So maybe your inventory isn't selling as fast as you thought. So now you have all of this inventory. You're going into a new season, and if you just want to store that inventory, it's going to cost money to store that too. So what these companies, they might do, they might just do a fire sale. They might just throw everything from summer on the discount rack, and all of a sudden, that inventory just isn't worth as much as they were expecting it to be. So that is a very bad situation of having too much inventory going into a period that may not be as favorable for the company. So obviously, you don't want to have a whole lot of inventory. It's better to have a whole lot more cash and short-term investments, because if a debt obligation comes by and you need to satisfy this right away, you can satisfy that with cash and short-term investments. Whereas inventory, you have to sell it first. So that is definitely the benefit of being a lean inventory versus having a ton of inventory in relation to your current assets. Now let's talk about other current assets. So other current assets is essentially this umbrella term, and it could be a number of things. So this can include something like prepaid expenses, restricted cash, or other items. Now, they don't necessarily have to disclose what these other current assets are. So generally, when you do see a large change from one quarter to the next, you might see a disclosure note that tells you, hey, this is why other current assets is so much higher than the last quarter. But here, you didn't really see that much of a difference. So oftentimes, you just see it nested. They don't really break it out. Sometimes they might break it out for you, but that's kind of up to their discretion. So let's just talk about these different types of other current assets. So it could be something like prepaid expenses. So maybe maybe I decided to purchase some software, okay? Now, this software is going to help me run my operations, and I paid a software company basically one time a year, and I get that service for the entire year. So that would be a prepaid expense, where I paid one time, and now I'm using that service over the lifetime of a year. Now, what about restricted cash? So restricted cash is going to be a separate line item from cash and cash equivalents, because this cash, it has a purpose. So it's being set aside for a certain obligation. So this could be something like an acquisition. So maybe I'm deciding to purchase another company with all of this cash. So that cash will be set aside. It will be called restricted cash, and it will be underneath the asset section. So this basically concludes current assets. And I hope you guys enjoyed this video. Stay tuned for the next video where I'm going to be talking about non-current assets.